Hey everyone, today we're going to pull back the curtain on one of the biggest and maybe most misunderstood industries out there, insurance. We're going to follow the money, your money, to see where it really goes and how this financial giant actually works.
Think about it. You see that charge hit your bank account every single month for your car, your house, maybe your health insurance. You know it's for protection, right? But have you ever really stopped to wonder where that money goes? It's not just sitting in some digital vault with your name on it. The real story, well, it's way more interesting than you might think. So to figure out where the money's going, we have to start with the fundamental idea that makes insurance possible in the first place. It all comes down to a simple but powerful concept: the pool. See, this kind of flips the whole purpose of your premium on its head. You're not just prepaying for your own potential disaster, you're actually chipping in to this massive, shared fund that's designed to cover the losses of the entire group. The system works by swapping out your own unpredictable, individual risk with a very predictable, average loss for everybody.
And this is the magic trick that makes the whole pool idea work. The law of large numbers is the mathematical bedrock of the entire insurance industry. All it really says is that as you add more and more people to a group, the number of bad things that happen, claims, becomes incredibly predictable. It's how they can look at millions of people and forecast with scary accuracy just how many car accidents are going to happen next year. And this just nails the point home, right? If you only insure 100 people, one or two big claims could totally wipe you out. It's a gamble. But if you insure 1 million people, the actual losses are going to be almost exactly what your statistics predicted. That predictability is what turns a massive risk into a manageable business.
Okay, so the insurance company has collected all of our premiums into this giant, predictable pool of money. So what now? What do they actually do with all that cash to run the business day to day? Well, your premium is basically paying for 3 big jobs. First, there's rate making. This is where actuaries, who are basically financial wizards, run the numbers to figure out the exact price you should pay. Second, underwriting. That's the company deciding if they even want to take a gamble on you, and for how much. And third, claim settlement, the part you actually care about when something goes wrong and they have to investigate and pay up. So those are the costs of running the show. But what about profit? This is where it gets really fascinating, because insurance companies don't just have one way to make money. Nope, they have 2 completely separate, powerful profit engines. Engine number 1 is pretty much what you'd expect: underwriting profit. This is just making money from the basics, collecting more in premiums than they pay out in claims and all the costs of running the place. Simple enough. But engine number 2, oh, this is the real powerhouse: investment profit. They take that enormous pool of our premiums and invest it, earning returns before they ever have to use it to pay claims. Let's zoom in on that first engine. How do we know if an insurer is actually any good at the business of, insuring people? Well, it all comes down to one single number that tells the whole story. It's called the combined ratio. The key thing to get here is that the combined ratio tells you, in a single number, if the main insurance business is in the black or in the red. It takes all the costs, the claims they pay out, and the expenses to run the office, and compares them to the income they get from premiums. It's basically their ultimate report card. And math is dead simple. If your ratio's over 100%, it means for every dollar you brought in, you spent more than $1. You have an underwriting loss. If it's under 100%, you spent less than you earned. Boom, you have an underwriting profit. The goal obviously is to be under 100. Now, just to peek under the hood for a second, that combined ratio is really just 2 smaller things added together. You've got the loss ratio, that's the slice of your premium that actually goes to paying other people's claims. And you've got the expense ratio. That's what it costs to keep the lights on, salaries, marketing, you name it. Add them up and you get your combined ratio. And here is the big twist. You'd think the entire point of this business is to keep that ratio under 100%, right? To be profitable? Well, for property and casualty insurers, we're talking car and home insurance, that's almost never the case. Get this. Between the years 2017, they only managed to turn an underwriting profit in 7 of those years. 7. They are consistently losing money on their main job. Which, of course, leads to the billion-dollar question. How is that even possible? If you're losing money year after year on the one thing you're supposed to do, how are you one of the largest industries on the entire planet? And the answer, as you've probably guessed, is all about that second engine.
The losses from the first engine are often just the cost of getting fuel for the second, much more powerful engine: investments.
This whole strategy actually has a name. It's called cash flow underwriting. An insurer might deliberately set its premiums low, fully expecting to lose money on the insurance side of things. Why on earth would they do that? To attract a massive flood of cash, your premiums, that they can then turn around and invest. The whole game is to make sure the profit from their investments is bigger than the loss from their insurance policies. And they are incredibly smart about it. A life insurer knows they probably won't pay out most claims for decades, so they can invest in long-term things like bonds and mortgages. But a car insurer? They need cash ready for an accident tomorrow. So they invest in more liquid assets, like stocks and bonds they can sell in a heartbeat.
So let's bring this all home. The biggest thing to take away from all this is that you have to stop thinking of an insurance company as just a risk management business.
The reality is that it's a sophisticated financial machine that uses one business, insurance, to collect capital for another, often much more profitable business, investing. Those underwriting losses we talked about are frequently a planned cost, completely wiped out by the income they generate from their massive investment portfolio.
Which leaves us with one final thought to chew on. When you pay your premium, are you just buying protection, a safety net, or are you unknowingly buying into a massive financial instrument that helps fuel Wall Street? The answer, as we've seen, is that you're actually doing both.